Now, which countries would be good candidates for this type of funder of last resort? In the paper, we describe some of the conditions that central bankers and other professional economists argue for such a funder of last resort role. This includes very low inflation, very low growth, very low or zero interest rates, usually high government debt such that governments cannot continue to try and stimulate demand by borrowing. In addition, we talk about the relative level of corruption between the fiscal authorities and the central bank. If the central bank is less corrupt and more competent than fiscal authorities, then it's clearly the central bank that should be providing this kind of funding. Assuming you believe that more independent central banks are less corrupt, more competent, then there might be a role to play for a funder of last resort in places like Romania, Bosnia, Ukraine, Bulgaria, interestingly Greece, and even if you kind of widen your judgment, you might consider central banks in places like Lithuania, Georgia, the Oman, serving this role as a funder of last resort in places where the fiscal authorities are seen as more corrupt and the central bank is seen as more independent and thus hopefully more competent and less corrupt. So what is the result of all this analysis? Figure 10 foreshadows our own results by looking at the variety of asset purchases undertaken by central banks in various jurisdictions. What this author shows is that countries at different income levels chose to purchase different kinds of assets in order to respond to the economic crisis. A one-size-by-all approach to assets will not work in various jurisdictions. What we don't know is the extent to which buying government versus private assets will help an advanced economy versus an emerging economy, and we don't know the extent to which that reflects necessarily on investment. Figure 45 shows the general relationship between central bank private securities purchases and investment as a percent of GDP for all countries everywhere, and thus to some extent for no country nowhere. On the x-axis, we show the extent of central bank private securities purchases scaled from 0 to 1. We talk as a percent of GDP, but they're scaled, so we're looking at countries that are buying relatively few private securities versus those that are buying a lot of private securities, and we're looking at those effects on investment. For those jurisdictions that are adding some private securities into their central bank's asset portfolios, investments increasing. For central banks that add just a little bit of private securities into their asset portfolios, we see a relatively large impact on investment, and we see this relationship grow steadily over time with bumps along the asset acquisition path. So as a central bank starts to accumulate more and more private sector assets, its impact on investment increases, but one cannot say that this is a linear or clear relationship, not only because we're looking at different countries, but we're looking at these countries over time. The main message, though, from this graph roughly shows the overall main message from our analysis. As central banks purchase more private sector assets and serve as a funder of last resort, that this helps to promote investment, except in those sloth cases, which we'll talk about a little bit later. Figure 41 shows the same relationship for different geographical regions. There are certain high points for a central bank's acquisition of these private sector assets. Thus, as if to tell the obvious, different regions and different countries will have different reactions to the way their private companies react as central banks start acquiring their securities. Now, it's not necessarily true that once a central bank starts to buy private sector assets, it just goes and goes. A central bank will probably want to diversify the assets it holds on its portfolios and adjust that mix depending on which market it wants to affect in terms of interest rates, returns, changes in prices, profits, and so forth. And we show some of the more pronounced examples of this relationship between the holding of central bank assets in general and the holding of central banks' private sector assets. Particularly for Tajikistan, we see that even though its central bank is not one of the bigger asset holders in the world, it has a relatively large amount of private sector assets relative to some of the other economies such as Angola, Burundi, Macedonia. These economies tend to hold relatively little private sector assets, irregardless of the size of their bank balance sheet, which is surprising because, as I've just stated, if a central bank works anything like any other investment institution, you would expect, and indeed you would want it, to have different kinds of assets on its balance sheet, if not for diversification or risk purposes, then even for broader fiscal policy or macroeconomic management reasons. Now, continuing on this theme of central bank private securities purchases as helping investment, the infographic we see in front of us shows the correlation between these purchases and investment. And of course, we've removed the effects of broader monetary policy, because otherwise this correlation wouldn't tell us anything. For some countries such as Bangladesh, Mauritius, Venezuela, Senegal, a lot of African countries on this list, central bank private securities purchases have translated into larger amounts of investment. Different countries over time exhibit different correlations between the way their central bank purchases private assets and the way investment grows in these economies. To take two of the most salient examples from Albania and Bangladesh, even if the change is the same, namely, even if for every 5% increase in a central bank's purchase of private assets, we see an increase in investment, there might be a level effect. In other words, a central bank might be changing not only at the margin, but also in absolute terms, the investment happening in some of these economies. As we were discussing before, we found evidence of a sloth effect. It might be crowding out, and the infographic we see in front of us shows some of the negative correlations between these central bank private security purchases and investments, of course after controlling for these other variables we talked about. Some of the countries with the largest negative correlation include places like Armenia, Tajikistan, Azerbaijan. Figure 29 shows the relationship for a group of countries where there's what we call the sloth effect, namely that when a central bank increases its purchases of private sector assets, investment actually decreases over time. And we simply document this phenomenon without actually commenting very much on it. Figure 50 shows what we label the true effect of central bank private asset purchases on investment. These estimates differ from the simple correlation analysis we provided earlier, because a correlation is just one time. You get 20 numbers, you decide on a correlation coefficient, and that's it. You might have gotten 20 other numbers in a different state of the world. But in this figure 50, we try and simulate all states of the world for which those data probably came from. Really only Panama there is an effect greater than one, namely that a central bank purchase of private securities will have a more than proportional effect on investment. We do see positive effects, and the blue bars we see in front of us show the 95% confidence interval of that effect in each of these jurisdictions. For the bottom part of this infographic, we see a fair amount of these countries having no discernible effect, namely the effect passes through zero, though in some cases there is a clear sloth effect in places such as Nicaragua, Georgia, Philippines. Again, we highlight Tajikistan. There are places where central bank purchases of private securities have probably done more harm than good. Figure 51 shows what engineers call a transfer function. This transfer function looks at the way central bank purchases bounce through an economy over time. Or imagine these purchases get sent into a black box and then get sent out as investment. But remember that unlike some of the examples we were showing you earlier called vector autoregressions, we're not just doing this one time. We're not just sending one pulse through and looking at the results. Instead, in this transfer function approach, we keep sending these private security purchases just as they've done in the past and looking at the aggregate effect over time. There are relatively strong initial effects shortly after these purchases, though the purchases also have an impact up to a decade later, probably reflecting the time needed to bring large, highly profitable investment projects to fruition. Now, of course, this leads us to the obvious question. If buying private sector securities is such a good thing, how do we do it? How do we put it into our law? Why don't central bank laws contain provisions for such purchases in the first place? And as we've mentioned in the past, it's partly because of conventional economic theory, which is focused on price stability, particularly after World War II, but there are other reasons which we absolutely don't have time to go into now. A recent IMF study, maybe only 20% of the central bank law focused only on price stability. A large number of these central bank laws looked at growth as a subsidiary objective to maintaining price stability, and in a relatively small proportion of economies, growth as an equal mandate to providing price stability. In easily more than half of these central bank laws, a highlighted objective to promote economic growth without necessarily the ability to actually reach into markets and get that growth for themselves. Looking at our own random sample of these central bank laws, we have sorted them into 6 categories, as you see in front of you. Rating 1 countries are basically the most antagonistic toward a central bank buying private sector securities, and we see a rating of 6 as the central bank's laws being extremely friendly toward the purchase of these private sector securities. Unsurprisingly, we see that most of the central bank laws covered in our review have a mode of 2, namely that promoting investment is not an objective in the central bank law, and private purchases are ambiguous in the central bank law. In many laws, they provide some kind of monetary board or the government the discretion to conduct these purchases if necessary, but don't really go into it more than that. In Figure 57, we look at different legal provisions from the countries we selected at random, and we look at the extent to which the central bank has rules as a lender of last resort, thus as a potential legal basis for serving as a funder of last resort, specific authorization for the collection of private collateral, and whether the central bank is nominally independent or not. Only about 25% of these central banks have a legal basis for using private securities purchases as a last resort. Even if the central bank wanted to support the economy, and even if it was vital that the central bank went in and bought some company stocks, bonds, asset-backed securities, and so forth, either A, they wouldn't be allowed to, or B, it would create such a controversy that their central bank management would probably not want to do this anyway. Thus, central bank laws could usefully be changed. In our paper, we specifically argue for a nominal GDP target as a primary objective for central bank law. The reason why we do this, not only because it's become very popular amongst economists in recent years, but also that it provides the flexibility to central bankers not only to focus on price stability, but also to provide the legal basis for having a mandate to buy the securities that the central bank thinks it needs in order to help protect output along with the other branches of government. The following infographic shows some of the options that are available to lawmakers from the countries that we've reviewed at random. The first option, the one that we prefer, is direct application of a nominal GDP target. Namely, instead of having 7 or 8 objectives, as is often the case in these central bank laws, that they would have a clear nominal GDP role, of course any other ancillary roles such as supervising a banking sector, if they should at all, but that's a completely different subject. And so the second approach then is through government policy. As we've seen in several of these central bank laws, the central bank receives its objectives and main policy directions not necessarily from its central bank objectives, as enshrined in law, but from government policy itself. So an easy fix could simply be that the executive or even the parliament decides specifically on either a decree in the case of the executive or some kind of parliamentary instrument in order to fix nominal GDP target, either annually or as needed. The third method of legislating a nominal GDP target might be then to define already existing objectives. As we saw in most of these laws, they list several, sometimes 8, 9 different objectives, most of which contain elements of a nominal GDP targeting, some even as broad as promoting national development and harmony. So to the extent that this abstract wording is then made more specific, specifically to discuss GDP and inflation, either in the short run or longer run, and also to specifically include holdings of things like private sector securities, that would probably make monetary policy clearer than simply saying, well, it's up to the Monetary Executive Committee to decide. The fourth way is to put these functions in a section dealing with the lender of last resort or stabilization. For a few of the central bank laws that we looked at, there's a specific chapter dealing with the central bank as a lender of last resort and or rules during stabilization during a financial crisis. There could easily be put in provisions allowing for the purchase of private sector securities explicitly, and perhaps even defining more clearly these broader objectives about promoting economic growth while keeping inflation down. Of course, you want higher level targets at a higher level in the law. Therefore, putting these kinds of objectives way down in chapters dealing with contingencies is probably less preferred. A fifth way of dealing with lender of last resort functions, and particularly nominal GDP targeting, deals with monetary unions. In 2 of the monetary unions we dealt with, the monetary union does have the explicit mandate to invest in developmental projects. This can become a very political process in which none of the governing treaties or instruments establishing these monetary unions decide exactly who gets what, when, where, and why. So one way of making this law clear and more accountable is then to decide on objectives for the monetary union, which of course there are problems with, as we saw in the EU, but nonetheless the EU is easily the most advanced of the monetary unions, certainly that we've looked at in our study, as a potential role model for making law that is fair to the various jurisdictions involved. The final approach to legislating a nominal GDP target might be in the way the central bank deals with national development banks. As we mentioned before, the central bank and the National Development Bank were often together and only separated over time. One method of dealing with nominal GDP targeting would be to give the central bank the authority to buy these private sector securities, but then offload them to a national development bank that could oversee, if not custody, certainly more active management in some of these companies, to the extent that that might increase the returns on these investments. Thus, to conclude, it seems that there's a limited role for central banks to purchase private sector securities as a way of promoting investment, particularly under well-defined circumstances when other types of monetary policy have not worked. We have found that there are better ways and worse ways of legislating or writing central bank laws in a way which allows central banks to deal with not only economic crises but deal with the challenges of promoting investment in this way. And we've considered drafting strategies not only for legislators but the economists that advise them. This has been another Infographic Instant with Brian Michael.